Good evening, everyone. Welcome to the Hurley Investments market commentary for the 21st of September. Tonight, I want to start on two things. And the first thing is this dire warning that has gone through, well, let's face it, it's gone through all of the money managers when Blackstone warns of a lost decade for equities and market returns. When they say anemic, they actually are talking about a 0% return for a decade. Now, we've heard this before, so this is nothing new. We have seen it before. When the executive vice chairman, Tony James, comes out and says, here's the problem. Interest rates will normalize, companies will face plenty of headwinds, which will put pressure on earnings. If I was to ask you guys as a group, what earnings headwinds are they going to face if interest rates normalize? Anyone know? Debt, bingo. In fact, that's funny. 4 of you came in with debt right out of the gate. And you are exactly right. The debt, to service their debt, especially if they have some of these variable bonds or so forth, to service the debt, number one, is going to be a huge expense. In that same category, to now purchase the materials for businesses other than services, even more, even higher. Two comments just came in. One says, although I don't think interest rates will go up anytime soon, I've got an article that says, at least for Powell, we're looking at 3 years. I agree with that, but I don't know if I would call 3 years the time horizon they're talking about. Last but not least, directly related to inflation. When inflation goes up, we usually try to charge more, which will hurt company profits when it comes to international competition. So when inflation goes up here and we have to charge more on an international scale, we fight that competition down the way. So plain and simple, we are in a period in the near future. I'm going to go out on a limb here. I'm going to say in the next 4 years after Trump gets out of office, if he wins. But it's been a while ago, I created the story of a dollar, and I have a little bit that I went over. This goes back probably 10 years. Oh, I guess it's 7 years. Can't go back 10 years if it only says 2013. But this goes back 7 years. And when I started, I really focused on 2000. And I started in 2000 because that's when I started to go all in the stock market with 401ks, sale of a business. It just 2000 for me was truly my all-in year when it came to 401ks and rolling the sale of a business over in a 1031. This was where it started for me. As I go through this, and this again is 7 years old. First rule, don't lose your money. Second rule, don't forget the first rule. It all talks about protection. But as I went through, I started out going over averages are not a good way to measure investment performance when they are set aside for retirement. Can someone tell me why? Why am I not a fan of averages? Why would I not be a fan of averages? It's kind of simple, but there we go. Because averages are linear. William, and by the way, everyone please welcome William. New clientele, new individual that likes this idea of being able to talk to me each week. William, this is the group. You're going to hear some names come up quite a bit, but this is the group. Glad to have you here. We got a couple hi Williams from Maud, from Jeff, from David, and David W. both said hi. Amy says hi. Well, Amy says welcome. All right, so correct. Averages assume a growth rate every single year, or an ATM, a constant upwards growth rate. When in real life, the market is a variable rate. Hence, this is the first reason none of you should ever spend money on a financial plan. A financial plan gives you a linear return in the market, and there has never been a financial plan that has ever come close to ever being correct. I had Morgan Stanley and a guy talked to me about it. I think his name was Alex. Well, it's kind of it's a flight pattern or a flight plan, and you have to adjust it based on the wind. I said I disagree with you. If it's a flight plan, it's a flight plan with holes in your damn fuel tank where you don't know when you're supposed to stop and go because you got to keep going all the time. But the big catch was this. And this is what I was trying to have people understand was average rates of return, 10%, 10%. This is the easy one. It's only worth 99 cents. But Kevin, that's only a penny. That's true, but when you went through 98 to 2002, you had 3 years of positive gains up 58%, 2 years of down days, 2 years of returns down 49%. So what do you think your average return was? Were you up 9% on the average? Because that's what's most likely stated. Oh, you're up 9%. Your 5-year average, you're up 9%. Bullshit. You're actually down 33%. Your dollar that went up to $1.58 is down to 77 cents over this 9-year, 9% average return. When you flip that around, you're off by 42%. When you're off by 42%, you just screwed your retirement. You're not going to be making it. It's time to change your retirement plans. And most people don't understand, we have had a lost decade. You can go 12 years down there on the bottom. I think it's 12 and a half years up there on the top. We've had our lost decade where your funds, your 401ks went here. Oh, you dollar cost average, putting the same in, up, down, up. Your return was 0 for 12 to 12 and a half years, almost 13 on the upside. Not only was it a 0% return, If you are in mutual funds, most people during this time frame lost between 35 and 42%. Well, my 401k had gone up. You would actually put your money in to a losing investment. But Kevin, they matched. And I scratch my head, and my comment is usually, God, you are dumber than dirt. Your first year, you had a 50% match. What you put in, they matched 100%, 50% downside protection. Your first year was great. On your second year, assuming you put the same $100 in, right? And they match the same amount. The second year, that match that they do for you only gives you a 25% net downside protection. Assuming you put $150 in every year and they matched you. But when you have $200 in, their 100% match is only 25% of the portfolio. And then when you go to year 3, for their 100% match, that match, that protection drops down to a 12.5% downside protection. The next year, it's a 6.25%. And by year 5, you've got a 3.125% downside protection on your 100% 401k match. And none of this money is usually yours until either you get fired from the account or you've done your 7 years. So with all due respect, on year 5, if you think your 100% 401k match is spectacular, I don't understand. The worst part about it, on 401k funds, most of those have a net cost basis of 6.25%. Hence, you don't hear a lot of people talking about, oh, I'm retiring on my 401k. Never happens. The reason why there's so many freaking Walmart greeters there is because these simple numbers don't lie. They don't. They are what they are. And people need to understand this. But unfortunately, sometimes, no matter how many times you try to tell someone, they're just too dense. The worst part about it is the market crashes greater than 15% every 4.2 years. You'll experience somewhere between 6 to 8 market crashes up to your retirement, and on average 6 market crashes during your retirement. If you don't have a methodology that'll deal with market crashes, it will most likely hurt your ability to stay retired. You just won't be able to maintain your same standard of living. When this came out, it was rather huge. This one report went all the way through money managers. It went through the SEC. It was a simple published report. I mean, I don't know how simple you can make it. It's not really a huge I don't know. I didn't get it. I didn't think it'd be this big of a thing, but it's huge. And it's huge because one person realizes how bad this hurt the people that were retiring between 2000 and 2012. Killed them. Absolutely killed them. With that said, last week, S&P was down another 6%, third week in a row. Not a huge drop, only a 0.5%. And it's interesting because you saw rotation. Gains in energy, industrials, materials, and healthcare outweighed the declines by communication services, consumer discretionary, and consumer staples. So plain and simple, energy, industrials, materials, healthcare. Energy is cyclical. It's that time of the year where you're going to see people using more gas to heat their homes. I'm not sure I understand industrials and materials. Healthcare's, I think this is foolish again. Money's dumping into healthcare because corona cases are spiking again with colleges and schools opening. Most companies didn't fare well. Most hospitals didn't fare well. Even when it came to lying and you know, you could have died by the coronavirus even though you were hit head on by a bus. Because it paid them 75 grand. But that 75 grand for making up coronavirus deaths didn't outweigh their elective surgeries. We typically do have a rotation out of communication services or technology, consumer discretionary, and consumer staples through September and October. That usually happens, but those are the big three that'll come back November, December, especially when it comes to the holidays and Christmas. Plain and simple, if I was to go through everything, the biggest issue was Federal Reserve Jerome Powell expects central bank's policy setting to keep lowest rate for the next 3 years. We had Facebook shares that fell 5.3% on yet again, another antitrust lawsuit that they've had in place for over 4 years, but it could file by year end. We also had an issue most recently with some fraud in the big banks. We'll see how that turns out. JP Morgan was listed and named there, but in all honesty, as we look at it, let's look at JP Morgan today. JP Morgan today, market close was down $3.04, about 3.9%. After hours, it's up 13. Still holding that $95 level. So could have been worse. It'll be interesting to see if there is some fraud in some big banks. Part of it tells me, it wouldn't surprise me when you see these big banks make the biggest returns, it's because they've done something illegal. Yet it's interesting, even though when the big whales get caught, they lose all this money, it doesn't affect their returns on previous years. They don't go back and restate them, they just go from there on out. What garbage. All right, with that said, we're all on markets end this week. Again, I said it last week, I'm going to go the same thing. I'm thinking lower, and all I'm doing is following the trend. So when some of you have asked me, Kevin, you seem to have been doing a really good job on being able to pick the direction shorter term. It's not like I've got some amazing technique. I don't have some ridiculous, what do you say? I don't have some, boy, I thought I just screenshot, there they are. I don't have some ridiculous new indicator, I'm just following the trend. On the Dow, we tested last Friday the 50-day, and it held. I warned you on Thursday that might happen, but the key was, would it break the 50-day? And it did. Chances are we're going to go down and test the 200. Kevin, why would you say that? Why would you predict we're going to go test the 200? Again, it's not that I've got some ridiculous, interesting, you don't know about idea or indicator. It's just typically what happens. The probability is that when you lose a serious moving average like the 50-day, and understand that no one in big money ever uses the 80-day or the 100-day. That's just TV talk, mumbo jumbo BS. The next stop down is the 200. That's where the biggest bulk of fund orders are going to sit, will be around that 200 range. In this case, when you look at the 200 over the last 90 days, look how close it puts you to the 3,000. A round number, there's probably a ton of bulk orders at 3,000. And we slowly were going above it, where we stayed right around that 3,000 for at least 45 days. When it comes down to it, usually taking 45 to 60 days to move orders around. Tons of orders are stacked up between 3,100 and 3,000. Probably a good level that we would come down to and test and stay at until our election. Nothing tricky, no weird indicator that you guys don't know about. It's just common sense. So the reason why I'm getting it right so far, I'm following the trend. Last but not least, the NASDAQ. This is the one that's a little scarier. This one could indicate the 9,000 range. When you look at that midpoint, it literally sits right at 9,000. If some of these were moved up that were below 9,000, they would probably go to 9,000. New ones that were put in here might be up here at the 10,000 range. But boy, we have a 1,200 point drop, and wouldn't surprise me to see it. Wouldn't surprise me to see the 20%. That we've talked about it. We're in protection. Your job now, and William, this is going to be new to you. William, your job now is to pray things keep going down. As your money comes over, we're going to put protection on it. Your main goal is you're now going to cheerlead when it goes up, and we have bullish markets. You're now going to be a cheerleader when our stock market goes down and we have bearish markets. Pretty neat to be able to still sell Apple at 125, 123.75 or 127. Pretty neat to sell Disney at 135. Facebook up at 295. Under Armour at 1150. Ford at 7. There's just certain levels here that we can sell our positions at a higher price. So hope for that drop, cheer for that drop. The farther it goes, the more shares we're going to pick up. We probably have already fallen more than 5% on the S&P. Let's do some simple math. Looks like 35.81. Let's take 35.81 minus 32.81. 32.81 shows that we're down 300 divided by 35.81. We're down 8.3% from the highs. really, we've got another 281 points. It's going to happen. It usually does happen this year. We're in the position to be protected for it. March it on down. Let it go on down. It'll be good for us to have happen. With that said, I'm sticking with my 5%. I should move it though. I mean, I really should. That's kind of chicken. If we're already down 8.3%, probably going to go down a little bit more. I'm going to move that down to 8%. It really wouldn't surprise me if we saw the whole 9% or 10% disappear for August. I guess, you know, down to 3,100, another 4. I really could see us being down 12.5% for September. Earnings, some interesting earnings. AutoZone on Tuesday, Hertz, which should suck. Nike on Tuesday, KB Homes. Fuller and General Mills on Wednesday. BlackBerry, Darden Restaurants, Trip.com, Vail and Costco. Carnival Cruises, I think, on Friday. I hope I've got the right week for that. Fed had a speech from Powell today. Wednesday, Thursday, Powell is at the Senate and the House testifying. Existing home sales tomorrow. New home sales on Thursday. Durable goods on Friday. Most likely, I would think, even though there are some smaller, that's not fair to say. There are some international economic reports that are coming up. Nothing's going to take precedence over our reports. So existing home sales will move the market on Tuesday. Housing price index and MBA actually won't do anything. Initial claims and new home sales on Thursday and durable goods on Friday. That will set, change, and move our markets. How am I looking to trade? We're mostly protected. I'm now looking for out of the money covered calls. I spent all day in front of the computer looking for those opportunities, yet our market came back rather uniquely, would be my best way to say it. The market came back in a unique way today. Whereas I was looking at it just on a minute by minute basis, we came down, we went up. I really thought, we're probably going to have a test of the bottoms again. It came down. I thought, all right, will it break that bottom or will we go higher? And I'm looking at this at 32.35-ish is where I kept looking at it. It did fall down below that, but it really fell down to 32.31. But 32.35 is where I was trying to make decisions. And then it started to go up, and I thought, I can't put on these short calls. I'll lose money. Little jibber jabber, right? Market went went to lunch, came back, and then I thought, is now the time to put it on? And our market was falling, and I thought, oh, for crying out loud, if it breaks that 32.35, I've got to add some short calls on. And I had a couple minutes in there where it touched it or came close, 32.35.60, back up. Here I am day trading it, right? 33.34, I should pull the trigger, back up. 32.34, I should pull the trigger. And then it just took off. This is what I was looking at, and this was my decision making that I was worried about when it came to adding those short calls. It was not a day that I could get a read on putting some out of the money short calls in place. I also didn't feel comfortable in saying, all right, let's put them on. We shouldn't be here. We shouldn't be there. I just wasn't comfortable with this chart pattern in today's movement. William, something for you to look at. Market was down 1.16%. Yes, I am down $91,000. So if we take where this started out today, which is going to be at what, 14,485, 14,485,000, or excuse me, 13,485,000 divided by 91, 970. 1345 divided by 1345 702 divided by 91,970. Let's do 91,970 divided by 1345 702. We were down 0.68. So here our market is down 1.16. We were down 0.68. The difference is 1.16 minus 0.68, a 0.5%. We beat the market by a 0.5% today. A little bit about what you can expect being with Hurley Investments. All right. Amazon spent years on what it takes to do great work. These 4 steps contribute most to success. High standards are teachable. You have to be teachable to reach those high standards. High standards are domain specific, meaning it has a specific area of interest. High standards must be recognized, and high standards require realistic expectations. Hence, William, when you asked, will I get an average 20% return in the stock market? My comment to you was to expect that every year you're going to be up 20% is stupid. That is a linear expectation in a variable return market. Can you expect to most likely double your portfolio every 4.5 to 5.5 years? Yes, but some of that may come on one stock position coming back, and that may not happen till the 4.5-year mark. So again, when you look at a stock market as a linear return or an ATM machine, I've told you in the past, and I think you've appreciated it being straight up with you, stupid. You can't look at it that way. If your expectation is to take 20% out every year, because that's the way your growth is going to be, you're kidding yourself. Now, could you have 20% in the first part of this year? Definitely. And if I can go back and just show you, it looked better before this little pullback, but on a pretty flat market, we're up, 1.477 against a, well, if you subtract that out against a 12 million in this group, we're up about 13.5%. If I went to a couple other groups for you, probably doing better here. We took this out, that was 10.6, where we're closer to about a 16%, 14.6% here. Let's see what Coda is doing. Coda probably is still beating me, that bugger. Coda on his 4.5, actually no, he's only up in that 11% range. So, a pretty flat market year to date, we're doing pretty darn good, is all I'm going to say to you. All right, here we go. Why skill is overrated? Don't know if I agree with that. Benefits of high standards. I do think you need to have those high standards. United says child remain unlikely to recover until vaccine is widely distributed. Duh, but I thought I should put that in here because so much has been talked about businesses getting up and running. In all honesty, I don't think we're going to return to those same business levels. Let's face it, some people think they can now work from home. That is not going to be true for most people. Most people, when you have a spouse that's also working from home and kids that are now being taught from school at home, one spouse's job is going to suffer. I will also go so far as to say people that work from home, usually the spouse does not understand that because their husband is home, he can now do honeydews all day long, or vice versa, because the wife is now home and working from home, she can just take care of the house. That's garbage. It is extremely hard to be productive and work from home. You have to be extremely disciplined to do your work. But I'm going to tell you, if you did put 4 hours of work in at home, you'd probably do as much as 8 hours you could do at a workplace. 2 comments were just made. That's why I need a door on your lock or door on your office. The other comment is lock the damn door. Then you have kids pounding on it. Daddy, mommy says you need to do this. Yes, but the short answer is I don't think our workplaces have changed as much as we think they're going to change, just as a heads up. Interesting article, please read through it. Pelosi blasts a skinny deal. I'm a little shocked. I would think some deal's better than no deal. They could always do a third one down the road. This is strictly on party lines. Obviously, if you're a Democrat and you believe Democrat, you're going to say, what a jerk that the president won't put the big deal in right now. If you're a Republican, you're going to say, what an idiot, Pelosi won't get something for her people and constituents instead of nothing. This is where politics hurts the American public. I wish they'd have some deal. With that said, part of me kind of wishes that Trump just would have done a big deal. I do like the fact to a certain degree that we are taking into consideration that maybe not everyone needs $600 a week extra. $300 might be enough. Maybe 70% of their income might be a good idea when it comes to getting people back to work. It's not fair for me to say because, in all honesty, I kind of want a pandemic every 2 years. It's brought my family home. The preparation that we've done, we already feel comfortable. It hasn't affected my job or my income other than boosting opportunities to find more people that want someone watching their portfolios every day and doing the best they can to make some money on the way down. So for me, I kind of like a pandemic every 2 years. It would go really well for me. A couple comments I'm going to not ignore, but I'm going to read one that really stood out to me here. Where does all this free quote unquote money come from? And who and when will it be ever paid back, if ever? I mean, yeah, let's face it, we're just screwing our kids. Our country looks bleak the next 20 to 50 years. It really does. Mathematically, we're in so much debt, we really can't pay it off. Mathematically, when it comes down to it, we're going to at some point in time lose our reserve currency status or our economic advantage over all these countries that we should have socked money away for the rainy day. This is where, whether you're Republican, Independent, or Democrat, all politicians suck ass because they've done a horrible job of running their budget and their household to give us a rainy day fund to protect us going into the day that some things were going to change. I'm so disappointed in our political system over the last 25, 30 years that we haven't done a better job of taking advantage of our economic advantage of being the reserve currency status. We're just idiots. We blew it. We blew it and we're past getting past it. Generational wealth is what's going to help your kids out. Interesting. Another Boeing. Here's the article I mentioned last week. I found it. It's here. Boeing is going to come back. I'm only 9 months late on thinking when it would come. Kudos, by the way. One of our investors, students, Jeffrey Schaffner, called it and said, Kevin, you don't understand the regulation of the government. I said, oh, Jeff, you don't understand economics and Boeing and their price line, their 9 years of built up revenue. Kudos to Jeffrey Schaffner. He was dead right, and I so far have been dead wrong. I talked about the last decade. This was just this morning. Stock futures were flat. Actually, at one point in time, the S&P was down 2.5%, was the worst I saw today. Good to see that it was only down 1, but we'll probably make up that other 1.5% over the next couple of days. Trump to pick a woman, and an amazing judge. Amy Barrett, I think, is amazing. More or less, she was approved by both sides of the aisle. It'll be pretty interesting because when it comes down to it, it really is the Senate's job to nominate her and to pass her in with then Trump to do the final sign off. It's the House's job to background check her. She's already been background checked. She was a candidate that the House would support in the past. It's rather horrible that on Facebook I saw, by the way, I'm a woman that was abused and sexually assaulted by Amy Barrett. I just remembered, and it really hurt me emotionally now that she will most likely be into the Supreme Court. I am disgusted with the House and how they're supposed to vet our Supreme Court justices, and really what a bad job they've done. Both sides of the aisle, Democratic most recently, Republican before, how bad they've done over the last 6 years. It's just disgusting. All right, what else do I have in here? I found the article for Social Security benefits. I made reference to it last week. Here it is, and here's the changes. Here are the numbers. Something for you guys to see about. Going right off of Joe Biden's platform. But let's face it, cutting taxes when you're so broke doesn't make sense. Yeah, let's face it, Social Security, if you are 55 years and waiting for Social Security till you're 68 for that middle payout, that's probably a bad thing to do because it won't be around when you need it. So it's shocking. Absolutely shocking. With that said, questions. What questions can I answer to you guys? All right. So William just asked, does picking a Supreme Court justice truly have an effect on the stock market? So the answer there is yes and no. Kavanaugh had a effect on the stock market along with other things at the same time. How would I say this? There is such a division right now between Republicans and Democrats that you're not allowed to have your own voice without being verbally assaulted on social media, on your phone, on your website. The type of fighting that you're seeing in the government creates uncertainty in the stock market. So whether it's real or perceived, yes, it has an effect. Should it have a real effect on the pricing? No, it shouldn't. But does it? Unfortunately, it does. So two things just came in. It evokes fear among investors because of the infighting. It gives a lack of confidence in our stock market and our rules and regulations due to our governments. So there's the short answer. Yes, it does have an effect on our stock market. And by the way, William, you had two funds that I'm going to go over with someone else tonight. Not that you need to worry about it, but there are some mutual funds that you had that I'm going to use as a couple of examples. I'll gather the information tonight, and I'll also forward that to you tomorrow on how much it truly costed, how much it was truly costing you over the last 5 years. And just know in general, I'm going to go over those funds with someone else. So I'll have that information to email out to you tomorrow morning or later tonight. Good question. Again, William, welcome to the group. Anyone else? Is there anyone else that has any questions? And William, yes, you can ask as many questions as you want. I try to set aside the last 15 to 20 minutes for you guys to ask questions. Can you show me another live example of what you're doing? Yes. So William, I don't know if you're going to fall into this category or not. You're not a student, but part of what we are doing, I'm going to go with Apple most recently. And Apple, that protective put position, well, Apple is up. Of course, it's testing that. So let me find one that maybe will work more. Pretty sure Baidu was down today. So when we have a stock that is down, but that's only 11 cents, that doesn't help us. Let me keep going. William, you kind of caught me by surprise. Let's look for Disney. So here's a pretty good example. And as you can see, I've gone through two other stocks that it hasn't helped out today. So again, I'm not sitting here saying, hey, we make up every money on the way down. But on a day like today, where Disney was down $3.22, it lost $50,000 in this group of investors' positions. For this group of investors, this group, their Disney lost $50,000. That long put protection, that insurance that I've talked to you about, we made up $40,820. Roughly looking at it, for today's drop in Disney, we made up about 80% of the drop. That's kind of the goal. The goal is, can we start out at that 50 and build that up to 75, 80%? For Disney right now, we're doing that, but that is the goal, and that's what we are trying to do with various positions. Make up some of the downside movement, cash that in, and convert it into shares. Kevin, how many stocks do you consider more than enough for a caller portfolio? So really it comes down to, I would always want to be in 5 to 7 stocks that are going to hit 9 to 11 of the sectors of the market. That means if you have a smaller portfolio of 100,000, you're probably not going to get those 5 to 6 stocks. You're probably going to get 3 to 4 that you want to look for some overlap or crossover. William, 4.2 million, you will probably get somewhere in that 7 to 12, maybe 14 positions. But usually I don't want to be in any more than 14, 15, 16 positions. If I can't hit all 11 sectors with 7 to 10, then I'm probably doing something wrong. So more than enough on $1 million, you can be in 7 stocks, hit all 11 sectors of the S&P, and you can trade like Warren Buffett. You can find what should be the best of the best. Not saying that it's going to go up. You're going to find 7 undervalued stocks that are fundamentally sound that have an opportunity to go up higher. They don't all have to be stocks that are down. I would obviously include Apple in any portfolio that was $250,000 or higher. I include Baidu for an international exposure that's directly related to Asia as a whole, but more tied to China, which is the second largest economy in the world. That's a great question, Abraham, and it really falls under that mantra: keep it simple, stupid. The simpler you can keep it, the better off you're going to be. All right, hey, let's see. Jeff, you're still here. Guys, I'm going to call tonight. Jeff, at the top of the hour, I'm going to give you a call. I'm just going to run over and get a quick fill up on my glass of water here. William, again, I'm going to go over with Jeff 2 of those mutual funds that were in your group that I'm going to do my research, and I'm going to kind of show Jeff so that I can present it to you and give it off to you tomorrow. Guys, have a wonderful evening. I appreciate you being here. Look forward to seeing you tomorrow evening. Have a good evening, guys. Good night.